And I'll start with Charles's background. He is the managing partner of local Hawaii LLC that specializes in public accounting. It's ECA LLP. Prior to joining the firm, he had background with a large international accounting firm in the Honolulu offices here. He specializes in, of course, tax and consulting services, has a wealth of knowledge helping not just small businesses, but also corporations, pass-through entities, trusts, if you have trusts, as well as if any of you are on nonprofit boards, please see Charles, he has that also. And across, of course, all industries. He is a member of the American Institute of CPAs and the Hawaii Society of CPAs. Marco, this guy, Marco, now I'm going to kill this, Marco Mijuskovic, comes from, it looks like Uzice to me, guys. I thought it was that because it's spelled U-Z-I-C-E, so I thought like rice, Uzice, but he tells me it's pronounced Uji. Okay, I'm going to kill that, so I'm not going to say, I'm going to try to repeat it. Senior partner at Wealth Strategy Partners. His background, he comes from the International Franco-American School of Management in Belgrade, where he got his bachelor's in business administration, came to Oahu, attended Hawaii Pacific University, not just got a bachelor's there, but he also has a master's in marketing, as well as a master's in information systems. He went on to start Wealth Strategy Partners in 2007, one of the co-founders, and that business today has grown to over 190 representatives all over the West Coast, so California, Nevada, Oregon, Arizona, Wisconsin. He also has the distinction of CEXP, which actually makes him one of the only financial advisors in Hawaii with that designation. What that does is it actually assists businesses in their business exit planning. So, wealth of knowledge between the two that you have here today. Please join me in welcoming them. So, before we get started though, I am going to say that their preference in terms of when they do their table topics is if you have questions along the way, they do want to address them. So don't wait until the end. Certainly raise your hand and we'll try to take care of it. That goes. And away we go, guys.
Judy, thank you. Good morning. Good morning. Thank you all for being here. We appreciate the opportunity. It's the end of the year. It's almost the holidays, right? It's time to get some things done. Just by show of hands, how many of you are business owners? Yes. Good. How many of you are C corporations? Yes. S corporations? A few. LLCs taxable as a Schedule C? Partnership? Partnership's good. Okay, great. Thank you. When people talk about planning, they were surprised, right? They were surprised when Trump got his tax law through. But Mark and I were surprised that everyone was surprised. No, because what we do know about taxes is it's always changing. What we can always plan for is change, right? So what we have here to start is just the historical tax rates. There was a point in time back in the late 1940s, early 50s, that the tax rate was 95%. What the, right? The federal government on the last dollar wanted 95 cents of that dollar, and they were getting it. Wow. I know, it's crazy. So while we talk about it being pretty tough for all of us now as business owners, it is. It's a fair amount between the Fed and state combined, for sure. But at our tax rates are somewhere around the high 30s. It's almost a bargain, right? I know. I volunteered. You're out. You're out. What we hope to cover today is we're going to talk to you a little bit about lower corporate tax rates. So if you're a C Corp, good news. We're going to talk about the fact that as individuals, if you're getting pass-through income, the rates are a little bit better. We're going to talk about some limited deductions and something very special, the pass-through entity for most of you, the 20% deduction. Okay. You got to like Trump. You're shaking your head. Yeah. It's okay. It's okay. You got to like what happened, right? If you're a C corporation, the tax rates went from 15 to 35%, 35% at $100,000. Now it's 21% all day. Look at you, just smile. Isn't that great? Thumbs up. So change in the planning, right, for you. Whereas before, because of the double taxation, you're doing all you can to take the money out, you're declaring year bonuses, you're buying stuff and all like that to try to get it down. That's a complete change for you, right? Now we can leave some money in there, we're gonna pay some money at the lower tax rate. So we know for sure, if you're a C corporation, you should have a change in your strategy, right? So all the rush to the end of the year to get things out, you may just leave it in. Yes, it's better, right? So that's good. For those of you that are pass-through, there may be a reason to have a C corporation now, because you might want to park some money in there. And in working with your financial advisor, like Marco, there are other strategies to take benefit of the 21% now, and then exit the money later, and still avoid the double taxation. Right? So keep that in mind.
And this tax
Yes.
break is till what year? Isn't it having a deadline year coming up?
Of course it does.
Yes.
2025.
Thank you.
It sunsets back, it reverts back to the old rules, right? The theory being that Trump would be reelected, he gets his 8 years, and he's out, and he says, hey, whatever happens, happens. So that's the change, right? What we predict is that there'll be so much support of the change, and if the economy does respond to it, and big business does spend more, then they'll be hard pressed to make any kind of a change. So we're hopeful. Yeah, good question, thank you. For the rest of us, right, everything's coming through. What we have is just a spreadsheet that talks around the change in the rates. So on the left side, joint filers, old and new. On the right side, single filers. So just kind of an example. What we're hoping, or what we expect to see, is for all of you, is about a 3 to 5% tax savings. We think your overall rate will go down between 3 and 5%. So if you're making $315,000 back in 17, you're paying somewhere around a 33% marginal rate, far left column, if you're a joint filer. Then you look just next to it, it goes all the way down to 24. So that's really good. That's 9%. That's a little bit better, right? But all the way throughout there is good. If you are an employee or you have employees in your company, the withholding rates had changed already, so everyone has already enjoyed that benefit. So when you get your W-2, you've got more in your net paycheck, not just because your employer paid you more, but because the rates have gone down. So that's changed already. So your employees have already seen that benefit. The planning opportunity is to talk to your employees about, because there's been this change, because there's found money, because the feds are taking less, we ought to encourage our employees to fund the retirement plan if you have one, right? You ought to put some money towards their savings account. 3 to 5% is almost not negligible in that way, because they're used to living without it already. So you're not great, thank you. The opportunity is that they would actually put that money towards their retirement. Right? We're trying to build futures for our employees as well. Everybody okay with that? Yeah. There's a lot of talk around it, so although the rates have gone down, we also know that the deductions for individuals have changed. So state and local taxes, so what we know now is that you're able to deduct only $10,000 worth of state income tax and real property tax combined. So probably all of you, when you're looking at the end of 17, you rush to pay your real property tax, you rush to pay your last payment of your state income tax. You did that in 17 because beginning in 18, the year that we're going to finish up now, you can only deduct the first $10,000. Anything more than that, it's not deductible. I know. Why not? That's how it is. Unreimbursed employee business expenses. If you've got employees that otherwise spend money and were otherwise able to deduct that on their personal return, that's gone away completely. There is no Schedule A deduction at all for unreimbursed employee business expenses. So if your employees are reps and they take their clients to lunch and they pay for their cell phone and they drive around and take mileage and all like that, that is absolutely zero. So the opportunity for you as employers may be, if it makes sense, is to consider helping them fund that through some kind of a reimbursement account where they submit expenses to you and you would otherwise pay them. They're still deductible by you as the employer. Probably the middle ground would be that they're doing it anyway. That's good behavior. You want your employees to do what they're doing to keep doing well. You might want to talk to them about that and maybe find the middle ground. Is they were used to doing it by themselves with their money. The opportunity maybe would be to split that. Talk to them about this now with if you're looking at some kind of a raise, something less of a raise, but also an expense account for them. So they kind of split the baby on that. you're getting the full deduction, they're not losing the tax deduction on that, but at the same time not having to take that into income. That's how you're making that a deduction for them. Right? That makes sense?
Excuse me,
Yes.
I have issues. So if you reimburse your employees that use their own vehicle and you reimburse them the 55 cents or whatever per mile, and they give you that report, that's not a deductible expense for us, but it would be if they bought the gas and gave us a gas receipt?
A reimbursement like that. Yeah. So we want to look at those. I think case by case, but you want to look at what they're spending the money on, right? If it's entertainment, a meal is deductible only up to 50%, but it's always been that way. Entertainment's gone away. We're going to talk about that a little later. So that's been a change. I'll cover that a little bit.
Can I follow up on her question? I'm not clear. She asked you if she, let's say she gives her employee $200 for his gas expense in travel. That should be a deductible expense to the company, should it not?
If it's a direct reimbursement of an actual expense, not just an allowance, it would be a deduction. That's right.
Okay.
So that's the opportunity. Right now, if the employee does it and it's unreimbursed, they're just doing it by themselves because that's what they want to do to get ahead. That's no longer deductible. Before they would say, hey, at least I'm getting a tax deduction. With that going away, it may modify their behavior, right?
Right.
Yeah, I don't want to do it.
But if it's documented, it is deductible then?
Yes, you got to look at every expense category, but it can be, yes.
Thank you.
Thanks for the question. Home mortgage interest. It used to be that you could borrow $1 million and deduct the interest on it. That's changed. Right? As of December 18th of 17, any acquisition after that date, the max is $750,000. That's the maximum amount of debt that you can have. So if any of you are, in addition to that, they've done away with the deduction for HELOCs. It used to be under the old law that if you borrowed up to $100,000 against your home, it didn't matter what you used the money for. You could use it in your business, deductible. You could use it to go to the Bahamas, deductible. The way it is now, it's zero. Right? So for any of you that are using the sweep strategy, right, where you have the HELOC and you use it and you always deducted the interest, that's changed. That's not a deduction anymore. Right? We're going to revert back to the old rules, which is the interest tracing rules. That says it may be deductible based on how you use the funds. The interest is deductible based on how you use the money out of the HELOC. So if you do use the money out of your HELOC against your personal residence and put it into your business, that interest is deductible by your business, not on your personal return. So it's the interest tracing rules. Trace the interest to how you use the money and deduct it there. If it's personal, non-deductible. If it's business, deductible. Use it on a rental property, deductible on your schedule, and all like that. Follow the money. Yes?
So it is deductible if it's a HELOC and you truly use it on your residence?
If you use it to improve your
Right,
residence,
okay.
thank you. That's a great example, then it would be deductible.
Up to, again, are you limited?
$750.
It is up to 7.
Yeah.
American Savings Bank not gonna like that.
No, there's still value in.
Yeah, I think the banks always focus on getting the right result on the financial side. The fact that we can try to tax perfect it after that is going to be an ongoing challenge, which is why they brought us in to kind of talk to you all about it. But you're going to have to get it done anyway. If your company needs capital, if you're going to do the renovation, you're going to do it anyway. They're going to just find you the best rate and try to orchestrate the loan to make it that way. They're really good about looking at what you have and prioritizing. If you've got excess capital in the business, the idea would be to take the distribution, take it to your personal, and then borrow against the business for what it needs to do. And they're super strong at that. Yeah, we work with them. They know what they're doing. So we encourage you to do that. Absolutely. Cash is fungible. Where you find it is how do you leverage your business for your personal financial gain? That's the opportunity, right? So to your example, how do you make it happen? You may need to move things around to get it in the right place, especially when you've got to trace the interest. It's a good example. Okay. Charitable deductions, they talked about making that less. Is actually more. You can deduct up to 60% of your taxable income. As your financial advisors, you should not be contributing 60% of your income to charity, in our financial opinion. But you could.
Say that again.
Yeah.
One more time.
You can deduct 60% that you give to charity and against your taxable income. More than half. I know, probably should.
Um,
And we're all
But on
saving
your
money.
personal, you deduct 100%.
Say again?
On your, if you, on your personal charitable deductions,
Yes.
you deduct 100% against your income, your gross income.
Yes, yes, it's both. So if you contribute $1,000 to the chamber, you will get $1,000 deduction as long as your taxable income is more than 60% of that. Right? So if your taxable income got down to 1,000, you would not have $1,000 deduction, even though you contributed, it'd be only $600 because your taxable income is only 1,000. It's 60% of your taxable income or your 100% of your charitable deduction, whichever is lower. That makes sense.
Yeah.
Medical expenses, if you have it, it's got to be more than 10% of your adjusted gross income. Hopefully it's not that way. That's a big number. Yeah. One planning opportunity, we had a client last year that she was going to just get a bunch of dental work done. It was going to be somewhere around $40,000 to do just reconstruct the whole darn thing. It's going to look awesome. But that's what they told her. It's, I don't know, it's $40,000, but it's good. What we ended up doing though is we actually paid in advance. We actually paid all $40,000 in the prior year. I know. Because she's a cash basis taxpayer, we were able to loosely deduct all of it in the year that she paid it, knowing that it was going to happen in the first 3 months of the new year. So by stacking those deductions, we were able to get over the threshold and deduct it in the year. So to the extent that you or someone you know has ongoing bills, and if it's unfortunate in that situation, the idea would be to stack it if you can.
Excuse me again. So medical expenses, as a business owner, then in addition to paying my own and my employees' medical insurance costs, is it an allowable expense that I could pay also up to a certain amount of their actual medical expenses to benefit them as a taxable deduction for me and not declared income for them? I'm gonna benefit my employees more. Well, yeah, anyway. So, I don't pay very
Are
much.
you hired?
Yeah, I did a property manager in Hilo, but I don't pay very much.
Tell me more.
Lava flow, exciting
Right.
floods, I mean, we
Property
have it all.
values, right?
Cold
You buy
frost,
something.
fire ants, you name it.
Yeah. Housing's inexpensive.
So I want to benefit my employees more, but I'm always hesitant to give them a pay raise, because a pay raise costs me so much money, and they take home so little of that.
Good.
You know, it just doesn't, it's like, oh my God, how can I benefit them? And then once you give them a raise, you can never go back down. The economy tanks, you know, a couple of years later, and you're like, can I take back that raise I gave you last year and the year before? You know, so I wanted to see if I could give them, benefit them and say, I'll pay you an additional $1,200 a year in medical by me paying your medical reimbursement amounts at about I don't want to prepay them, but you know what I mean? So that would become a benefit for them as a tax deductible for me.
Well, she's asking if she can pay their medical.
So they have certain medical savings accounts that you could do. It's a fringe
Well,
benefit.
I pay their full medical, dental, drug, and vision, okay? And so that's already paid for, but when they go to the doctor, the dentist, they always have to pay their deductible. So I'm looking at trying to pay whatever portion comes out of their pocket up to a certain level.
Good. Let's poll the audience. Who has that sort of a setup? Anyone? Yes. Can you help maybe share how you do it?
We're starting a new business, but I'm also on a sabbatical, so I'm an educator.
Okay.
And so my school provides up to $1,000 any medical expenses that the employee has paid that they reimburse, above and beyond the benefits that they give.
Well, tell me your name.
Ajanta.
Ajanta is taking a sabbatical, but her employer is actually giving her an allowance of up to $1,000. And what she's sharing is there is a health savings account that you as the employer can set up as an offering, and it allows the employee. So this is not for you, but for to benefit your employees. They can set aside money pre-tax and fund that, and in that way, it's it's a deduction for them because they're taking out their income, funding it, and then just they submit for reimbursement in that way. Similar to what you have, is I suspect the same type of program. So as long as bills go in and they're qualified expenses, we get the reimbursement tax-free.
It's called flexible spending account, FSA account, so you can research it or you can ask us about it later on.
And it's optional, right? It's not, there's a cost to set it up and to administer it, but super strong for your employees if there's a good, if there's interest in it, for sure.
So if you're looking to pay employees additional, but you're worried that next year maybe the revenue stream goes down, and then you don't wanna take that away from them and reduce, we usually suggest set up some kind of retirement account, qualified retirement account, where you have a flexibility to contribute to that account on their behalf or not. So you can, I'm not sure how big is your company, but if it's a smaller size, you can set up simple IRAs and maybe match up to 2 or 3%. If it's a larger, over 10 employees, then you can set up the 401k with the matching or 3% non-elective contribution to that. And you can pick and choose. And they really don't see it if you stop because it's not coming to their paycheck, so they're not used to it. So if you stop contributing to their 401k to the matching or non-elective 3%, they're not going to feel it. You can also set up the retirement accounts where you can, up to your discretion, contribute every year a certain percentage. And that goes, every dollar you give them, actually, they're going to see it on their retirement account statement. Because if you give them $1 to the payroll, they're going to see 60 cents out of it because 40 cents is going to go to the taxes. So there is a way how to do it. I do have something set up. Okay, thank you.
A question on the FSA though. It used to be use it or lose it. Has that changed?
We can find out for you.
I think it's still the same.
I would expect it
It's
to
use
say
it or
never
lose
or
it.
anything.
Instead of Hawaii, there's also health savings accounts. Actually, there is none instead of Hawaii because of the way how we have our medical set up, but just in general across the United States, there is a health savings accounts that actually work like IRA accounts, and those are not use it or lose it, like a high co-pay accounts. Unfortunately, we don't have them instead of Hawaii, so we have FSA accounts, but those are use it or lose it.
Yes.
For our company has flex spending, so we
Okay,
allocated, and they allow us to roll over up to $500.
Nice.
So I don't know if that's the maximum allowed by the IRS, but we allow through them $500. I don't know if it's not quite a use or lose it, but it's,
Yeah, there's some safety, yeah.
yeah.
Good, great, thank you. Thank you for sharing. Thank you for sharing it. Okay, is it okay? Okay. So for all of you that have a business that the income passes through you, Schedule C Partnership S Corporation, 199 Cafe, that's the new code section that applies to you. How many of you have done the planning around that?
Can you say that?
You nod your head that you knew it, but you're shaking your head that you did anything about it. Bless you. Bless you. Yes. New code section, you gotta like Trump. I went for love like. 21% on the corporate side. That'd be a rebellion from all of us individual owners, right? So this is, we're trying to create parity, or they're trying to create parity. So the opportunity is that you can exclude from income up to 20% of the income that you derive from your business. So if you're getting a K-1, 20% of that number is not taxable at all for federal tax purposes. You got a Schedule C, same thing. If you got a rental property and it's actually profitable, congratulations, you're in Hawaii making a cash flow, it's amazing. But if you've got a taxable profit in your rental property, 20% off, no federal tax. You must be something other than, look at the bottom left, other than a specified service trader business. If you're a specified service trader business, you don't get it. If you're an accountant, if you're a financial advisor, if you're a doctor, a lawyer, anything where the business makes its money either based on the skill or reputation of one or more individuals. If you're a specified service trade and you don't get it. If you're real estate, you're out.
Property management out.
I know, bummer. But wait, there's more. I forgot there's more. If your income can fall below 157.5, top left box, if you're single, or 350,000 of taxable income, you're back in. That's kind of cool.
Even for a specified
Yes.
service,
Yeah.
so a financial advisor would still be able to write off 20% income if the income is below 315?
Kim, are you asking a general question, or are you asking by your?
Very specific.
Yeah. Imagine that. Yes, to all of it.
Charles, what would be an example of a non-specified service trade or business?
Contractor, retailer, maybe entertainment, trolley company, snorkel tour, a lot of things actually. Consulting, specified because it's your service, right? Yeah, but we would look at how you're doing it, right? So, can we split out what you do, right? In terms of, is there component parts to your business? But if you're a consultant, even if you have people working for you, it's still a specified service. It's one or more individuals, not necessarily the owners, to qualify for it. But we want you to all look at your business. Is there a way to bifurcate what you have and how you earn it, so that some of it is service and therefore not, and the rest of it is? The best opportunity is to just get your income below. Bless you, bless you if you're making more than 350, isn't that great? Just pay the tax, almost, but, you know, it's a tough go, it's okay.
But if you're individually you're a sustainability consultant, and it's up in the air as to how wide your purview is as a consultant, then perhaps it would be non-specified.
He's asking, you're asking if the scope of your work and who the clients you service, would that have an effect on whether you're specified? I think not. They've just issued guidance on it. It's like, I don't know, 400 pages. So we're going through it now. The cool, not cool thing is ours has years, right? They tell you the law, we all try to get our heads around it, and we apply it, and 3 years later say, hey, by the way, not quite what we thought, right? But I think our view is the guidance is going to be broad. They want to give it to you because they're giving it to the C Corps. So our prediction is that they're going to be pretty fair about it. They're going to create a lot of opportunities. So to your question, we don't know, right? So we want to be careful to give you good advice. So we don't know. So we should be aggressive in our planning. Am I being recorded? It's okay. Okay? This is a lot. We're going to break for 5 minutes. Call your CPA right now. Tell them this afternoon. 199. Oh, and there's more. There's more. Sorry, there is more. I'm serious. In order to get, if you're not specified, if you're a contractor, you can get 20% of your K-1, up to 50% of the payroll out of that company. Right? So if you're a contractor grossing $5 million, payroll's $1 million, you're netting $500,000 in net profit. 20% of your net profit is $100,000. In my example, payroll was $1 million. 50% is 500. 500 is greater than the 100. You're going to deduct 100. We've got a client. They've got a supply business. It's going to make $1 million. Almost no payroll. It's amazing. It's a great business. 20% of $1 million is, is it for sale? 200,000 is the net profit. No payroll because it's just selling stuff, right? And it doesn't need employees to do it. Deduction 0 because payroll is 0 out of that company. So what do we have to do? We've got to generate payroll in that company, and there's some rules that you can get around it. But you got to be aware of the two-prong test, right? It's 20% of the K1 or 50% of the wages out of that company, whichever is lower. Right. Complex. We just want to make you aware of it. Definitely screenshot this. Actually, we can probably send this to you, and then just let Trina or Reiko know, and then we get this to you. Your CPAs know about it, it's okay. I keep pointing to the whiteboard like it's gonna change. But by the way, we didn't tell Rachel and Ben that we needed, so they were kind enough to rush get it, so thank you both so much for taking us out. It's better with the slides, right? Okay. If we're gonna be above 315, how do we get below the 315? What I'm gonna do is I'm gonna switch it up now. We got something. Everybody okay? How's our time?
Pretty good. Still got about an hour.
We're not gonna go for another. Lucky. Okay, so we have an Excel, and it just, yeah? Yeah? Can you help me? Can you follow me? So, actually be okay. So gross revenue, it's just simple, 500,000 in revenue, those are all the expenses from it, that's 379. Can you go to the second sheet? Marcus, our best dressed. Can you go, let's start at the top. Let's start at the top. All the way up. Yeah, thanks. So I have a Schedule C versus an S Corp. There's a subtle difference in the two of those. In my example, from the first sheet, 379 was the income. In the right-hand column, 279 and the 100. That's the two pieces. Basically, we're talking about the same amount of income, 379 in total. In that middle section, rows 16 and 21, just some itemized deductions. The amounts aren't necessarily important, but just that it's there. And so you get down to taxable income of 344. So Mark, can you show in the bottom section, 344 down to the, yeah, good. So right now, we've got income tax of about 162,000 and 153. So there's about a $9,000 difference between a Schedule C versus an S Corp. For any of you who are operating in the Schedule C, you want to look at changing that. There's some inefficiency in that form. You can still be an LLC, taxable as a Schedule C. You can be taxable as an S Corp. You can be taxable as a partnership. All possible. We think an S Corp is a good, efficient tax way to go up your business. So we encourage you to do that. There's a $9,000 savings every single year on that. But take a look at this. What we know is that 344 is over the 315 limit, right? So we're getting almost no. We're getting no, in my example, no pass-through exclusion, right? So, Mark, can we go up to just above that, as in the same spreadsheet? I have a section there, retirement contribution. Okay, so go to the bottom just real quickly, and then come back up to row 14. 160 taxable income. Keep your eye on the left-hand column. 162. Keep that number in mind. Remind me. Then go back to the retirement. Can you put in 50,000 in there into the retirement plan? The first column, 50,000. What happens if we put $50,000 towards a retirement plan? What was tax before?
162.
162. 105. $50,000 in retirement plan gives you a $58,000 tax savings. I put it all together. I was getting ready to send it to Margot, and then
Because of the threshold.
because of the threshold, right? Of course I did it just to make it wow. But it's accurate, right? I was north of the 315, and I got under the 315. This is factual. This is how it's going to work for you.
The payroll is deductible from the threshold as well.
Oh, like that.
Payroll is not deductible from the threshold. Because that is not income in that way out of the business. It's got to be from the payroll.
The threshold is a gross amount?
Threshold is your taxable income. It's a net amount after itemized deduction, your mortgage, interest, and all like that. Everything is deducted off of that.
But payroll would be a deductible expense off of your gross income, right, before you get to taxable income.
True.
So you'd wanna spend some money right now, if you had to get yourself below 350 on your business in order to put in 50,000 to your employee. self-retirement account. And then,
You're like the most generous business owner I know. We almost couldn't work with you.
I'm getting really old, and I'm paying way too much in taxes for the 100 hours a